We should think of gold not as an investment, but as a form of money. So what the savings you used to keep in dollars ought to be in gold now, because gold is a form of money that's going to hold its value while the dollar is inevitably inflated away. And what's happening in China now is interesting because they have capital controls. Their people aren't allowed to, for instance, buy things overseas at scale. And there's a lot of things they can't invest in domestically, but they're allowed to invest in gold. And they are worried about what's going to happen to their economy. So they're buying gold as a form of insurance against the crisis that they see coming in their currency and in their financial system. We should have that same attitude.
After years of going nowhere, gold launched into the next stage of its bull market. While inexperienced investors might feel inclined to capitalize on recent profits, such a move could prove detrimental in the long run. The precious metal has been breaking out recently amid higher-than-expected inflation in the United States and general anxiety over everything from geopolitics to the November presidential elections to where monetary policy and markets go. Former Wall Street financial analyst John Rubino offers insights into the complex dynamics shaping gold markets. From his viewpoint as a technical analyst, Rubino mentions the fallout of abandoning the gold standard while emphasizing the resultant debt issues. The most recent Congressional Budget Office projections put U.S. debt at 99% of gross domestic product by the end of this year, and have it on track to reach 172% by 2054. This scenario could trigger monetization, inflation, financial repression, and market turmoil, a scenario in which gold shines. From John Rubino's viewpoint as a renowned analyst, he suggests a strategic pivot away from dollars towards gold for savings, citing its resilience against anticipated inflation. Concurrently, analyst further underscores China's adoption of gold as an insurance policy amid economic turbulence, signaling a worth-noting strategy. Chinese buyers, spooked by a protracted property slump and a recent stock market rout, are rushing toward gold as economic uncertainty looms, propelling a global bullion rally. Gold consumption in China rose 5.94% from a year earlier to 308.91 tons in the first quarter, the state-backed China Gold Association said Friday. Meanwhile, China's imports of gold raw materials surged 78% in the same period, helping the country's total gold output to jump 21.16%. With a forward-thinking perspective, Rubino advocates for physical precious metals as cornerstone assets, complemented by ventures into sectors like mining stocks. According to Business Insider, gold miners experienced their best performance in a year in March 2024. During that month, the gold mining sector outperformed all other U.S. industries, surpassing even the performance of semiconductor stocks. Still, physical gold has outperformed shares of gold mining companies over the past 3 years by one of the largest margins in decades. Now we present the clips of John Rubino's insights from his recent interview with natural resource stocks. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Where we are now is the result of an experiment that we started in 1971 with fiat currencies, where we basically did away with the backing of the world's major currencies, took gold out of the equation, and gave the big governments an effectively unlimited credit card. And, human nature being what it is, they've abused that privilege to the point where everybody at every level in every major country is wildly over indebted, which means we're pretty much guaranteed chaos going forward. And the nature of chaos is that it's not predictable in its specifics, but in kind of a broad brush analysis, it's very predictable. Wild, crazy things are going to happen when the various bubbles start blowing up. And Bob is exactly right. We need protection from the chaos. And that should be kind of the overriding investment thesis here is what can we do to make ourselves resilient and to an extent impervious to financial crises, because that's what we've got coming our way in one way or another. We should think of gold not as an investment, but as a form of money. So what the savings you used to keep in dollars ought to be in gold now, because gold is a form of money that's going to hold its value while the dollar is inevitably inflated away. And what's happening in China now is interesting because they have capital controls. Their people aren't allowed to, for instance, buy things overseas at scale. And there's a lot of things they can't invest in domestically, but they're allowed to invest in gold. And they are worried about what's going to happen to their economy. So they're buying gold as a form of insurance against the crisis that they see coming in their currency and in their financial system. We should have that same attitude here. So the gold bug attitude over the last 30 years of buying has served them pretty well, I think, now, because now they've got big stacks of gold and silver. Um, but yeah, I don't think we should, have any kind of a religious attitude about any one asset. And I think the different variations in the precious metal space account for different points of view. For instance, you want precious metals, physical, where you can reach them as your replace currency. That's the base money in your financial life. And then from there, you can branch out into other precious metals related things like the mining stocks, which they're investments. They're not money, but they're potentially really lucrative investments. So you can stay kind of within the hard asset space where there's land and there's precious metals and there's some other commodity investments with your whole financial life. You could build a portfolio that basically just covers the hard asset, the real asset waterfront. Those are things that governments can't create more of on electronic printing presses. And you can be in pretty good shape financially if you do that, because you'll be owning things that will tend to do all right in the kind of crisis that's probably coming. And that's the intellectual challenge. How do you want to set your portfolio up so that it's mostly in real assets? And, which copper companies do you choose to invest in? Which gold miners, things like that. There's a lot to think about, but it's containable. You can, a regular person can learn enough to be able to do that. And I think that's what we should all mostly be doing now.
Despite historically low interest rates over the past decade, Rubino warns of an impending crisis in commercial real estate and potential refinancing challenges at higher interest rates. He predicts that upcoming debt maturities could trigger a banking crisis, leading to government bailouts and undermining currency confidence. Over half of the world's foreign currency reserves are held in US dollars, so a sudden decrease in the currency's value could ripple through the market for treasuries as the value of these reserves drops. As heavily indebted lower-income countries struggle to make interest payments on their sovereign debts, the diminished value of foreign currency reserves could threaten to tip some emerging economies into debt or political crises. Furthermore, Rubino states the uncertainty of the near-term economic outlook, with conflicting inflationary and deflationary pressures. He emphasizes the need for individuals to prepare for potential crises ahead as significant challenges loom. Let's get back to the interview.
We had naturally low interest rates. So a lot of commercial real estate in particular got planned and designed and built using really cheap financing. Well, now a lot of those debts are coming due now. And there's no way a big chunk of the country's office buildings are still financially viable if they have to refinance at today's interest rates. So you're seeing, every 2 weeks or so, there's a story about some $180 million office building that sold for $12 million or something like that. Well, now that means there are embedded losses in commercial real estate. And somebody has to take those losses. And a lot of that bad paper is on the balance sheets of local and regional banks. So in the year ahead, well, actually, it's an ongoing thing. It's happening now, but in the year ahead, it's going to get worse. A lot of local and regional banks are going to have to report those losses. And that's going to spook their depositors into pulling money out, which forces them to sell some of those depreciated assets and take even bigger losses, and so on until the banks start to fail. Then that spreads through the sector. The U.S. government has to step in and bail them out. And then that shifts potentially, it shifts pressure over to the currencies, because, who wants to own the currency of a country that's doing yet another multi-trillion-dollar bailout? So that might be the story of the next year, where banking crisis leads to some kind of a broader crisis in the financial market. So I have no idea what's going to happen in the next few weeks or a few months. But the big picture is kind of baked into the cake. We borrowed way too much money, and in order to finance all this debt, we have to create enough currency that's going to devalue the currency in some fundamental way. So that's the overarching thing. Now, in the short run, now we've got cross currents, especially in the U.S. economy, where on the one hand, the U.S. government is running massive deficits. We're at like $1.5 trillion a year right now, heading for $2 trillion. And that's very stimulative because they're just making money out of thin air and dumping it into the banking system. On the other hand, you've got all this debt out there that is being repriced and spiking everybody's interest costs. So personal interest expense, which is what, we three and everybody else has to pay on our debts, is going straight up. And the government's interest expense is going straight up too. And those are fundamentally deflationary because they make it hard to pay off debts and lead to defaults. So we've got this kind of, this mountain of bad paper, which is very deflationary out there. And we've got a government that's just running massive deficits, which is inflationary. And so that's why we got this kind of stasis economy right now, where inflation is above the Fed's targets and it's not going down. But the economy is, it's providing mostly enough jobs for people, but there are more and more layoffs out there at the same time, and more defaults on credit cards. Will probably win. And, I have no idea which one it'll be in the next year or two, but we either have a kind of deflationary crash like in 2008, or we have rising inflation, and then we get the 1970s on steroids. And I honestly don't know which one it's going to be. It seems like it could be either, depending on the decisions that are made going forward. That's why we should all be trying to protect ourselves as best we can against some kind of crisis, because something is definitely coming.
Despite the departure from the gold standard years ago, gold prices have remained significantly influenced by central bank actions. While Western central banks may not prioritize gold prices in their currencies, they do exert control over factors that impact gold prices, such as central bank net purchases or sales, real interest rate expectations, and longer-dated energy prices. Given the growing volatility in the global economy, how do you plan to safeguard your investments against currency devaluation and financial instability? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.